Negatively yielding bonds are a curious phenomenon. Investment-grade munis are considered a risk-off asset class. How and when to use the tool is just as important as the tool itself. High-yield bonds, known as junk bonds, tend to move in high correlation to the equity market. This is a face-off rigor report video on two intermediate municipal bond exchange-traded funds, or ETFs. As always, consult with your financial advisor. Should be one of your first steps. Hello, this is J.R. Rigger of the Rigger Report. Today I'm being joined by Justin Lowry, Chief Investment Officer of Global Beta Advisors, to talk about dividends in this challenging investing environment. Justin, welcome to the Rigger Report.
Hey, JR, how are you?
Doing great. Okay, Justin, can you help us out with the challenging environment that we're in? We're looking at areas of growth and trying to invest in those areas, but it's become increasingly difficult, and investing has come at increasingly large premiums due to the global economic recession from the pandemic. Can you help us understand the current environment for the market in general, as well as stylistically between growth and value?
Yeah, thanks, JR. And yeah, so really what we've seen lately in the broad market in general, as well as kind of the split between value and growth, is just kind of this bubbling of valuations. And the way that we look at it is through the lens of, price to sales ratio. And, even on a short-term basis, valuations have become increasingly large. In fact, normally the S&P 500 trades around 1.5, 1.6 times sales, but recently it's traded closer to 2.5, and it's been above 2 for the better part of the last 3 years. And in fact, when we look at it in general, the S&P 500 is trading about 19% higher than its 3-year trailing average. And value, which is normally, kind of the safe haven when you're talking about valuations, is also trading at a premium at about 9%. And we define value by the S&P 500 Value Index. And the S&P 500 Growth Index is trading at about a 30% premium to its 3-year trailing price to sales ratio. So you can tell just across the spectrum that valuations have just become frothy. And, a lot of that has to do with the fact that, record low interest rates, the risk premium is kind of really there for equities right now, especially right now, but it has been in general for really kind of, the past decade. Coming out of the financial crisis, there was a lot of obviously stimulus and as I mentioned before, rates being suppressed quite low, and that just gives a better value proposition to earnings growth in the equity markets and kind of the risk on appetite that's existed there.
Well, why do valuations matter in growth stocks when the objective is that those stocks eventually are supposed to grow into their valuations, right? And to that end, how do investors find value in growth with valuations expanding by the day?
Yeah, no, JR, you're right. I mean, and the thing is the proposition is horizon, right? When you're talking about growth, you're talking about horizon, and you're not necessarily talking about the current here and now. However, our research has shown that, and what we kind of did is we built a kind of a benchmark for each of the indexes, for the S&P 500 broad market index, the value index, and the growth index. And so what we did was, roughly for the S&P 500 growth index, the long-term price to sales ratio average is about 3.5. And we noticed that the forward-looking returns on average, when the price to sales ratio of the S&P 500 growth index is above 3.5, results in negative returns on all of a 1 and 5 and 10-year basis. Right now, the S&P 500 Growth Index is trading at nearly 5 times sales right now. So that's significantly higher than that kind of self-imposed benchmark. Now, that's not to say that just because it's above the 3.5 threshold that we looked at, it means that every single period has been negative returns. It's just that on average, if you're talking about probabilities, you're unlikely to see not only a non-lofty return prospect, but you're looking at flat to negative returns. And again, that's on every spectrum of an investment horizon on 1, 5, and 10 years.
So how does Global Beta mitigate the valuation risk that you're warning against?
Yeah, so as I mentioned before, when you look at the spectrum of investing in growth, you're looking at it through not the here and now, but what's going to happen, 5, 10 years from now. How is that earnings growth going to look in terms of being able to get into grow into those valuations? And one of the things that we use is a white paper that was written up by two St. Joe's professors. Our stock price is destined to fall. And what we found in there is they kind of present a formula that justifies companies' valuations. And the way that they do it is they look at the price to sales ratio and they look at operating margins, expected operating margins, and they do that over the course of a 10-year period and say, what does this company have to grow by over the next 10 years in terms of where its current valuations are and kind of what the expected operating margin is going to be. And so what we did here is, creating our portfolio, we look at the current sales growth of a company and we measure that against that expected sales growth prospect over the next 10 years. And we're saying if the sales growth can exceed what is expected, then that gives better relative valuation for the portfolio. So we want companies that are showing that current growth that's better than what they need to hit over the next 10 years. And also we look at, introducing mid and smaller cap companies into the equation, because sometimes, when you buy companies, when they're smaller capitalization, you have the prospects of better return growth there because their valuations are less. They're kind of unsuspected, they're not the titans of the industry yet. And so that's why what we also do is we also look at market share growth in those names. What are the next, big growth names? What's the next Apple? What's the next Tesla? And I'm not saying that we're landing on those types of companies, but the parameters we're putting in place, the inputs we're putting in place is we're looking at industries that are growing. We're looking at companies within those industries that are growing, and we're creating a scorecard that allows us to figure out what growing companies and growing segments of the market can we find and do so at appropriate valuations.
I couldn't help but notice that your firm, Global Beta Advisors, recently filed to make a change to one of your exchange traded funds or ETFs. The symbol is GBGR. Can you tell us about what objective you're trying to reach and why make a change at this point in time?
Yeah, so it kind of all ties into what we've just been talking about right now. Specifically, large cap growth has become extremely saturated in terms of valuations. And so our original investment objective was more of a large cap growth objective. And so what we've done here is we took the strategy that I was kind of touching on just now, and we're migrating from the existing large cap growth objective and moving to this one, which introduces more size, more kind of emerging companies, as I mentioned. And as a result, the valuations are a little bit more reasonable. So, right now, the price to sales ratio of the portfolio that we were transitioning from was about 3.7. Again, lower than the S&P 500 growth, but still quite high, and above that 3.5 that we were talking about earlier in the discussion of, what do return prospects look like above and below 3.5. And so we looked at this portfolio, which is, a little bit over 2.1-ish. And, again, it comes down to, a couple of things that aforementioned approach of looking at what companies need to grow into in terms of justifying their valuations. So, for example, we're not owning Zoom, which is trading at 70, 80 times sales. Sales growth is immense and great, but even that kind of growth is not enough to justify what you need to grow over the next 10 years. And so that's what we're looking at here. That's what we're trying to migrate to. And again, just logistically, moving investment objectives, I think investors don't understand that it's not uncommon for funds to have a change in investment objective, and you don't need a shareholder vote to do it. And so I think investors need to make sure that when they are notified of these changes, to be on the lookout. I think it's easy to discard, shareholder notices, letters, and things that come in the mail, but it's important to know what's under the hood. And I would not say to buy a back test or buy performance, buy the strategy, buy the philosophy. And that's kind of what we live by. If you buy into the philosophy, you buy into the objective, you normally end up on the right side of the equation.
Yeah, so making sure that new design, that new objective fits into the investor's investment objective is really critical. And that transparency that you're providing to the marketplace and to your shareholders needs to be looked at by those shareholders for sure.
Oh, exactly. And that's the thing. We encourage investors to make their own decisions, obviously, and to really understand what the objective is and how that's going to impact their asset allocation.
So how do people find out more about that particular ETF and the changes that are underway?
So if you go to our website, globalbetaetf.com, you can go, that's our ETF webpage, and you can scroll to the fund GBGR, which was the existing ETF, and you can find out more information by clicking on the prospectus and reading through the investment objective.
Hey, Justin, thanks for joining the Rigor Report and talking about income investing, challenges and growth investing and the changes to GBGR. It's important that we get the messages out and that investors understand the changes in the market and the changes in the tools that are available to them.
Yeah, no, thank you, JR. I appreciate the time.
This has been JR Rigor of the Rigor Report with a Rigor Report interview with Justin Lowry of Global Beta Advisors. For more information on income investing, please join me on LinkedIn as well as on the website, straighttalkaboutbonds.com.